My name is Brad Laddusaw, president of the California Mortgage Association, and I'm joined here with Jerry Feinstein with Spreo Capital. I have known Jerry for a number of years through the California Mortgage Association. We always have kind of off the cuff conversations at the conferences and random texts and phone calls. So we're like, shit, let's just do it on camera and have some fun with it. Jerry has been a longtime supporter of the CMA, and he's recently stepped up, him and his partner, as the signature sponsors for our spring conference coming up here in Newport Beach. So, Jerry, I just want to personally thank you for that. We can't have our conferences and fight the good fight without support from companies such as you guys. And so I really appreciate you guys stepping up with that. So with that being said, would you mind taking a few seconds introducing yourself and your
Yeah.
company?
So I'm Jerry Feinstein, co-founder and principal at Spreo Capital, and just to set the record, Brad is one of the reasons why I joined the CMA, because he's just one of these guys who's running his own business, is running his own shop, deals with all the same headaches that all of us have to deal with, and he devotes a huge amount of time to getting guys like me to step up and to participate in the organization and to run the organization and to keep everybody happy, which is not an easy task to do. It's like herding cats. So want to give a shout out to Brad and all the great work that he does. It goes unrecognized a lot, and so I just want to go on the record to recognize the great work that Brad and others and all the other folks that spend their own private time to support this organization. So Brad, just a shout out and a tip of the hat.
I appreciate that. That's probably why I drink so much bourbon on the weekend. But hey,
Well,
we'll leave that for. We'll probably get into that later.
liquid happiness. But yeah, so Spreo Capital, we are a private lender. My partner Dan Frankel and I started the company in 2020. We came out of another shop and went out into the marketplace like a lot of the folks out in members of CMA to originate RTL loans, to originate DSCR. We do a lot of ground up construction, renovation. We're currently in 22 states and growing, and dealing with a lot of the same issues that the folks, when I go to the CMA conferences, I talk to people, what are you dealing with? And we're all dealing with very, very similar issues. But our goal is to be the best at what we do with the clientele that select us as their lender. And we try to do our best to ensure that they have a good experience with obtaining the financing, and then if we do a good job, come back to us again and again and again and again.
And you guys have had a pretty remarkable journey and growth trajectory. We'll get into that in a little bit because
Yeah,
it's not as easy as like, hey, we just want to hire and grow. There's a lot that goes into that. So you said you
right.
started the company in 2020, you and your partner. When you guys first started, was it just you two, or did you have one processor
It,
helping out? Because
it was
how was that process?
partner Dan and me in a warehouse in Chatsworth. So we did everything. So that's why as we get bigger and bigger, if anybody tells me their job is this, their job is that, I say, wait a minute. Between Dan and I, we've done every single function in the shop, including, drawing loan docs, closing loans, servicing, you name it, originations, underwriting. So we know exactly what every step is because we've all done it personally. So
And I think that speaks to probably, and I haven't met your business partner in person yet. I'm looking forward to that, but you a whole lot over the years, and I think that speaks to your leadership style as well. I have a hard time asking someone to do something if I haven't done it myself,
right,
or have ironed out the kinks. And part of having a good team behind you as you guys are growing, ideally, you want to hire someone that's better than you at that position that they're doing, and they take ownership in that position. So in 2020, did you guys start beginning of 2020, the middle, or when you made your decision, we were like, oh shit, COVID's happening. So did we
it
make the
was
right decision, or were you guys just
It
locked?
was right at the beginning of 2020, and COVID, no COVID, we just said we're going to be doing this, and we did, and we had clientele that knew us and loved us, and um, and we just did our thing. And again, I at that time my partner may have had a different kind of vision, but I was never expecting us to have the explosive growth that we had. I was just looking to do loans with clients that I liked and hopefully clients that liked me, be able to eventually pick a team of people that I'd like to work with and just do good business. and just take it from there. My partner had the vision of, growing a national company and eventually securitizing and do all the fancy stuff that the big companies do. I was just looking to make a living and do a good job and just have customers say, "Hey, thank you, Jerry, for getting us the financing on a particular property."
Well, I think that's the importance of I mean, you could definitely go out and do this on your own in this industry. It's
Yeah.
hard, and it's hard with a partner, as well, and
Yes.
it's good to have those, I don't wanna say competing visions, but it's almost like a push-pull factor,
Hmm.
on that to where you're in the weeds on the day-to-day, processes, policies, procedures, as is your business partner, but then he's also, "Hey, here's the infrastructure we might need 2, 3
Right.
years down the road to where we can't just put a Band-Aid on it and allow us." So how was that first year with you guys? What was
It,
the
it,
first if you remember, I mean, everyone remembers their first deal,
it,
so how was that
it went.
excitement when you guys got your first deal in
Oh,
and
well, we got to remember that I had been doing this for 6 years
Mhm.
before that at a very large and reputable shop. So I had seen what we call a lot of reps. So I've seen literally thousands of RTL transactions before that. So I kind of had a good understanding of how these deals go and all. But obviously, when you're on your own and you get that first deal, it's like, hey, somebody believes in us and trusts us that we're going to, do the loan. But it brings up the old joke in the business, which was, we get the first loan in. I go to my partner. I got good news and bad news. All right, what's the good news? We got the deal. And what's the bad news? We got the deal. Now we got to perform and we got to process it. We got to make sure everything checks out. We got to fund it on time. We got, 3 weeks to fund this loan and so forth. But yeah, so it was weird because a lot of people asked me, hey, were you nervous about, leaving an established, I had a salary, an established job and going out on my own. And it was weird. And I've been in the mortgage business for a very long time in the conventional side. I didn't have the fear, or maybe I should have, but I just kind of knew what I knew. I knew what my partner and I were able to produce and to provide. And we worked really, really hard. There's no substitute for the amount of hours that we put in. We were doing 16-hour days because we were doing everything ourselves at the first go around. It just built from there, and we hired a first employee and then our second employee, and then off to the races.
Yeah,
Yeah,
it's the
it's the
first deal
first
because you
deal because
work
you
so
work so
hard, and
hard.
I mean, you establish your personal brand, your
Yeah.
relationships, your reputation is really the only thing you have in this industry, and a lot of times you get that one shot, and
Oh
especially
yeah, you got one
that
bite at the apple. Yeah, exactly.
yeah, especially the first deal, and it's like you have clients that trust you, and they're gonna put your faith in you, and it's like, yeah, we have the infrastructure, bare bones, and Corey and I talk about this all the time. We go back and still look at our initial checklist we put together to
Yeah.
start our company, and it's like it was an Excel spreadsheet. It's like, all right, we got to do this, we got to do this, got to do this, and but it happens fast. That's the first deal you guys did. Was it just a bridge loan or RTL, or is it more on the construction side?
It was interesting. The first loan that we did was a borrower who I knew from the past who got themselves they were doing a construction loan and their current lender could not uh, perform. And a bank, it wasn't a prep, it was actually a bank. So they called me in a tizzy, said, "Hey, we have to close this loan. I got 2 weeks. Can you take care of it?" And I knew I had the advantage of I knew the people ahead of time. Wonderful people. We still do business with them. They're one of our charter borrowers. But it was a ground up construction transaction. They were midstream and they needed to refinance. And we went out, we took a look at the property, went through the stuff and closed them out. But yeah, it was, and they're still thanking me to this day for helping them out of a jam. I was like happy to do our first deal as Spreo Capital. To them, they're still thanking me, 5 years later and we just closed another loan with them, just by the way. So again, and that's where it hit me that, and I tell people this, I tell my own people that we don't source loans, we source relationships and we source sponsors. Because again, in the RTL business, particularly with the construction side of it, you're really betting on the ability and the wherewithal of a particular borrower to be able to build what they're going to build on time in a way that's compliant with all the regs and permits and all that kind of stuff. So once you find a really, really good builder who's, has the not just the ability and they know the local building authority, they have the necessary equity in order to, work with our debt and they get it done, it's they're solid gold. And that's why everybody in the industry is hunting down those groups of builders, of sponsors who are really good at what they do.
No, and it's tough to find, and then once
Yeah.
you earn their respect and trust, and you close a loan or fund a loan for them, you gotta fight tooth and nail to maintain them, and it's not just dropping pricing and increasing leverage, it's being a value add kind of, across the board, and it's
Yeah.
easier said than done.
Half the battle is showing up and half the battle is just being responsive. So, I get a call Saturday night, and they have a need to get their draw through quickly or whatever the issue might be, and you just pick up the call. I was joking, somebody asked me, what are your hours? We have set hours for the company, but when you're dealing with customers, all hours are your hours, and and I'm sure, Brad, you get calls at all times, and and as the owner of the company, you have to make that decision in terms of, do I put my money where my mouth is in terms of taking care of clients. And I think that's the missing element that I'm seeing in the latest iteration of not just our world in private lending, but in just everything today when it comes to everyone's turning to computers and AI and all this automation. But at the end of the day, I think many of us, at least many of us on the older end of the age scale, like to talk to people and like to talk to confident people that they know that are going to take care of whatever my issue is. So that's where, again, going back to the initial question, we founded the company on this idea of taking care of the customer. And that means getting on the phone, explain whether the news is good or whether the news is bad in terms of our ability to perform on a particular, deal scenario or request. But we just tell it like it is, be very, very transparent. And it's interesting. I've had situations where somebody, requested a loan that we don't do, like a cash out refi on a 7-Eleven in Idaho and say, hey, sorry, not my, but I know 3 guys that can do that loan. So here's some numbers. Tell them Jerry sent you. And so they look at me and go like, well, you don't do it, but you're still providing me a solution. And again, that's the focus that Spreo Capital's had. And I think one of the primary drivers of our success is this concept of taking care of the borrower, whether you can do the deal or not.
And it's a no strings attached type of intro, and I think
Yeah.
that's what carries the most weight, and a lot of times I'll be having a conversation with the borrower, and it's just not our cup of tea, but
Mhm.
I'm good friends with a lot of my competitors, and we've talked about where you need to
Yeah.
talk to Jerry or you need to talk to so and so over here. They'll run you through it, good, bad, or indifferent, very early on, and just that accessibility. Even as you guys have grown, it's still you picking up the phone when someone calls you versus just punting it to
Oh,
someone else.
absolutely. And then I'll make another plug for the CMA. I don't want to make this a CMA. I will make this CMA plug. So I tell people that you go to the CMA conferences, and I tell you that you can go meet anybody in the conference. And chances are you compete head on with them on about 80% of your credit box, the type of loan. But I guarantee you there's going to be 10 to 20% of the fringe that there are things that they do that you won't and things that you'll do that they don't. And so you could make a really good living of just exchanging referrals to co-members of the CMA, even though you may be fierce competitors on 80% of the business. So in other words, it's the only place I've ever seen where you can become really good business partners on someone who you compete as a competitor on a chunk of the business.
That's very true. And then also, I feel everyone's willingness to share some some pain they've gone through, whether it's on an underwriting or a regulator type audit
Oh yeah,
situation,
yeah.
to where you ask the question, they'll be like, "This is exactly how it went down. This is what I would have done differently, or this is what we were doing that really saved our bacon."
Oh
And
yeah. Oh, yeah. Yeah.
there's that, and
Oh, absolutely. When I remember in the day, Richard Temmie would tell you that, back in the 80s, I did a loan where, I'm still paying for it, whatever, and he would like scare the living daylights out of us because of like, well, don't ever do this because if you ever ask what can go wrong, let me share you,
yeah,
It's kind of like that scene in Jaws where the guys are showing each other, where the sharks bit them and stuff.
yeah.
But I'll tell you, him and Uncle Chuck Hershon, what I deemed as godfathers of the, private lending, at least in the
Not
LA.
self-proclaimed either. They just
No,
they
no,
just
no.
are. Yeah. Yeah.
If there was ever going to be a CMA, or a private lending Hall of Fame, their first ballot, inductees. Which, oh, by the way, it's not. I think we should do that. But anyways, these were guys that have been doing this literally for 50, 60 years, and they would bring to us guys who, as much as we thought we would knew, they would say, "Hey, let me tell you what really can go wrong on a loan, and let me share with you how to avoid it." And they were very, very open about sharing that information just so that we all can stay out of the ditch. Which was like, you don't see that in other areas of mortgage lending. Everyone's very secret, very close to the vest with their experiences. But again, back to the CMA, it's the only place I've ever experienced where, full-on competitors are sharing with you what would be deemed as trade secrets in terms of stuff that they experienced to help you avoid the pain that they went through simply because they just want to give back to other lenders. It's just unique.
No, it really is, and you can't really put a price tag on that.
No,
I joke around and say I didn't join CMA to quadruple my business. I joined CMA to make sure I'm still in business 10 years from now.
no,
And it's
exactly.
and we're always just one or two bad loans away from being in a tough spot. So
Yeah.
just and the compliance and the legislative risk, I think, is the biggest risk in any loan, not necessarily
Oh no.
underwriting that
Yeah.
borrower.
Absolutely. Absolutely.
So you made a funny point earlier, huh? It's my company, so I gotta make a decision. Am I gonna answer that phone call on a Saturday or not? I tend to joke around about work-life balance. When you're coming out of
Yeah.
college, everyone's just saying, "You need to find a place with good work-life balance." And then as you work for a company and then potentially going on your own, work-life balance isn't necessarily working less hours. It's just working shitty hours at your own choosing. So it's not.
Right. Right. Yeah, it's interesting, and I can even argue that millennials. I don't want to get into age, whatever, but some of the younger folks have a much more emphasis or have much more emphasis beyond just income on work-life balance and having their time off. And that's fine. Um, Unfortunately, in our business, it's real estate, and real estate doesn't happen 9 to 5. And so, again, it's what I'll also say is that, and I've seen this. There's no one right way to do this business. So I've seen, every different business model you can, and there's no one correct way. There's just a way that works for you and your customers. All I know is that the way Spreo Capital is built, we're built on taking care of that borrower, and if that means picking up the phone, we pick up the phone. And that's that's where we've chosen to compete.
Yeah, so let's touch on your guys' growth you've had since 2020. I think it's been a lot of fun to watch, and it's not easy. It started just as you two. How long into the yeah, after you guys started your company, did you make your first hire? And who and what position was that for?
We made our first hire in, wow, it was probably in about 2 years. I would have to go back and check
Yeah.
my notes, but it was probably about 2 years from when we started. Because that's where we were able to do enough business the first year. And just so that you know, when we started the company, we were self-funded. We didn't take, we had offers for venture capital and so forth. We didn't take a penny, because I didn't want to owe any money to any. It's fine. I'm in the lending business and I didn't want to be a borrower.
Yeah.
So Dan and I did everything. And when I mean everything, we did everything. And we got to the point where we said, we can't, this is not sustainable and we need to grow this thing. But part of that process was also kind of tweaking and determining how to set up our operation. And I'll digress a little bit. I'll give you an example. So, and again, like I said, there's no one way to do this business. Every lender does it slightly different. We just chose certain lanes to be in to say this is where we want to stake our flag and how we want to go out and compete and provide service to our borrowers. So, for example, when a borrower comes into us and says, "Hey guys, can you do a loan like this?" And they've got a legitimate live deal. They're buying 123 Elm Street. Hey, Spreo Capital, you know what can you do for me? before we'll issue an LOI, we'll pre-approve that loan. We'll go through, we'll do it down and dirty on the valuation, on the deal structure, on all that information. And when we issue an LOI, it's a legit LOI, meaning it's a live. In other words, if you sign that and everything checks out, we will fund on those terms, with the understanding that the value would come in, and the guy's credit score is what he claimed it to be, and so forth. Other lenders choose not to do that, and that's fine. I'm not making any judgment calls. So what we did then is we tweaked and worked our own internal processes to ensure that we're able to maintain that concept, and we still do it today, where every LOI is a live, legitimate, pre-approved loan. Those terms are set, cash is allocate, we have the cash allocated, ready to go. It's not like we have to go hunt for the loan, for the money. That's the loan. And we had several iterations to figure out what's the best way to accomplish that, and also to inform the borrower that, hey, if you're telling me your FICO score is a 740 and it comes in at a 580, all bets off.
Things will change. Things will
Right,
change.
right. And so the first couple of years, we spent a lot of time just tweaking and going through the iteration, and with us personally doing it. So it's kind of like we're perfecting the chocolate formula of our new company, and we finally got it just right. And then we expanded on that. Because again, what I've learned in my past days, I used to work for a small mortgage company called Fannie Mae. You may have heard of them. And I also worked for Fannie Mae e-business the first time I went to work for Fannie Mae. And what I learned there is that you can automate anything, but if you have a bad process, you're going to automate a bad process. So before you can even get into the technology and automate all this stuff, you got to perfect your process and then bring the technology in to automate it. So it was about 2.5 years before we hired our first employee. It was somebody who we worked for in the past, who was let go by his previous employer, and needed a job, and we knew him. We hired him, and we said, whatever we need you to do, like, order appraisals, order credit reports, process. So he started out as processing, and then he worked his way up to be an LO, and was very, very successful in being an LO.
Yeah, that time frame. I look at from, shoot, 2018 interest rates were running away. 2019 got hyper competitive. 2020 we had COVID. 2021 ultra cheap money. It's just a lot of emotions in the market that we went through. 2022 interest rates started running away, and there was a
Yes,
lot of really good um, professionals out there that no longer had a home. So it just
yes.
kind of timing worked out on that, and it's tough because then as a company, at least Corey and I. I'm not speaking for you guys. We were either too slow to hire someone or we're too busy. And it's like you eventually have to make that business decision and say, "Hey, we're gonna hire someone. What we're doing works. Our origination strategy works. Our loan products do have demand, but we can't do everything forever." And you get stuck in that doom loop of being
Yes.
busy, then slow, and busy, slow, busy, slow. Um,
Exactly. It's one of the hardest decisions you have to make as a early on in a business, and depending on how you want to grow it or not, is when to make the hires. When's too soon, when's too late. God forbid someone leaves you and says, "Hey, sorry, I found a better something elsewhere," and now, you know, how am I going to plug the gap, and so forth. So it's really some of the personnel part of the business is probably some of the hardest issues that Dan and I still deal with in terms of those items. Um, yeah.
how large is your team now? I haven't asked you yet.
We just hit 20 people.
So
So
20
you're
people.
still relatively small compared to, our peers. And that's by design. Because again, what I told my partner early on was that the more people you have, then your job as the execs end up being more dealing with personnel issues than the actual business. And I'll probably regret saying this, but doing loans is the easy part. Just making sure people are doing the right thing and borrowers are getting treated properly and so forth. Then having everybody who works for you just making sure we provide the best environment for people to want to get up and go to work in the morning, is the hardest part, because again, we're dealing in a very dynamic industry, dynamic business. The markets are changing, every day, and competition is changing and getting fiercer. And so, how do you maintain a staff of people that has the same enthusiasm to the foundational principles of our company, taking care of that borrower, number one.
Yeah, I mean, pride of ownership in their day to day. I mean, it's tough to find someone that can sustain that accountability or high level, high
Yeah,
standard that you as an owner would like that anyone to hold themselves to, but at the end of the day, you gotta remind ourselves, it's my company, not theirs. So how do I build the culture and make everyone feel like they're part of the team? And, how has that been for you guys over the years?
Right. It's interesting. People ask me when we started the company, because again, like I said, I've been in the mortgage business for a very long time, since the '80s. And people, when we started Spreo Capital, a number of friends of mine who knew me for years said, "What took you so long? We knew you're gonna finally go start your own company, and did you do it for the money?" And I tell people, yeah, look, we all work for a living. That's what we're here for. But ultimately, I said, really, the biggest reason for starting the company, in addition to the financial aspects of it, was the ability to handpick a team of people that I can work with. So, like, you go work for somebody else, and they hire you, and they say, okay, here's a bunch of people that you're working with, fit in, and you have to adapt to the culture and all the people. Whereas with your own company, you set that tone in terms of how you want people to interact. But I tell you, I think right now, as we're in our current iteration now, 5 years into it, going on our 6th year, we're fast approaching our $2 billion origination mark. And expanding is, how do you maintain an environment where people really want to come to work every day? Because ultimately, going back to the foundational principles, are taking care of that borrower. People always ask me, well, how do you know you did a good job? You need to do a survey. I go, I don't need to do a fancy survey. They come back to me on their next loan. I know we did a good job. If I never hear from them again, we screwed up, and I got to figure out what we did wrong. What can we fix it? So again, the idea then is, and that's the beauty of private lending, is unlike conventional lending, where mom and pop go buy their house to live on Elm Street. We have a sponsor who, if you do a good job, he's coming back to you on the next deal and the next deal, and it's what we call the wash, rinse, repeat borrower, who we're all after. But in order to satisfy that person, the whole experience has to be, when it's not just, they can go to 100 different guys that can provide the money. It's, did you provide it in a way they that it was a pleasant experience, not a bad one, and they were treated properly, communicated with. So again, the demeanor and the way in which our staff interact with borrowers is so important. And that's the hardest thing. To your point, is how, what are the criteria? How do you go find people? Is it, do you go find experienced people and try to train them up into the way you want to do business, or do you just find inexperienced people and train them up from the ground up? And those are just some of the things, the questions that we deal with every day, in terms of what's the right formula for bringing in the right people that can advance our vision for how we want to expand the company.
And we're very much in the people business, and everyone
Mhm.
that we hire is it's under our umbrella, and it's our brand and our reputation, at risk if they go scorched earth. And I like to say, I mean, we're going through the hiring process right now. We have a new sales guy starting, soon, and it's going through that interview process was, and we chatted about this,
Yeah,
a few
yeah,
weeks ago. I feel like you can't teach sales, you can't teach a personality. I could teach you my loan product, but,
right.
when you're hiring for a certain position, it's almost, and some people just interview extremely well, and
Oh yeah.
others just are just not good test takers. So it's like, how do you get through that and put them in an environment through the interview process to kinda shine? Because the last thing you wanna do is turn someone away that could be, the next top performer, or just as bad, bring someone on board that could be the weakest link, or a bad addition. So how has your guys' hiring process
Yeah,
been?
and LOs is totally different than a staff person, a processor, or a customer coordinator, as we call them. And like, there's no one way to do the business, like I said. So, and that's where, you look at somebody who, and what's interesting is, when you talk to, I talk to my peers at other companies, and everybody wants to, hire that big producer out of a particular area that is doing really well. And the first question you ask is, well, the guy's doing so well, why does he want to leave his current company? But ultimately, what type of business are they doing? So, some of the LOs, have a wide swath. So they want, commercial deals, and, apartments, and, single family, and they only want to do it all. So you have to, the first question is, are we even a good fit for that LO in terms of our product? We have a distinct product mix that we have today. Will we have different products in the future? Yeah, but right now, this is what we have. And this is our credit approach. This is the stuff we'll do. This is stuff we won't do. Here's where we'll make exceptions. But that's the hard part with the LOs, is just making sure that the way in which their world exists, fits with your world. And then the other part is making sure you got a really good back office to support them in the way they do business. So we took a long, hard look at our LOs and say, what do we expect from them? So again, it just comes back to your business model. Our business model is that we want LOs that know their stuff and can really answer the vast majority of questions up front without having to go back to an underwriter and say, hey, can we do this, or is this exception possible? And that's hard to do in terms of finding. There's not a lot of experienced veterans in our space. There are some, and everyone's, the recruiters are all trying to pick them up from different companies. But it's an ongoing issue that I think we all face in terms of sourcing good LOs that are going to, you know, represent the company ethically and bring in good performing loans and not take the easy way out or shortcuts that can cause to problematic loan performance. When it comes to the processors and the ops staff, then it just comes down to and you can't train attitude or approach. I don't even think you're allowed to use the word attitude in
Hey,
the
this is not an HR call, so we'll put the disclaimer. It's like
but it's like why it's no different than any of us as a consumer. If you get on an airline, you go to a restaurant, dealing with your cell phone company, any interaction, you can tell within the first 10 seconds whether you're going to have a good or bad experience. But if you go to on an airline, when you walk on the plane, like why isn't on one airline I'm greeted with like, come on board, well, whatever,
we
and
got
the other
drinks. Let's go.
they're not even like, they're not even like paying attention to you. Well, why, And so it comes down to two things. One are the airline itself, or, and I'm just picking on airlines, but
Yeah.
it could be any company. It's their adherence to standards, and then secondly, the people, in terms of, do the people there have the direction and the support, and I hate to use the word, but morale. Do they feel good about offering? If they're pissed off at the company and they're in a labor dispute or something, they're not going to be real conducive to taking care of customers very well. So that's really the hardest part of this whole thing, is to your point, which is not only recruiting and finding the right people, but how do you maintain that spark of staff that really want to go the extra mile, that really want to take care of a borrower, that, like you said, with many of our customers, we end up becoming friends with people because it transcends the transaction. um and it's you get there. It's a lot harder than it looks in terms of doing it, and doing it well and sustained for a long time. And so again, it comes back to, you can have rates, you can have leverage, you can have, speed, but you got to be able to treat the borrower well. And that all comes back down to how good your staff is and how good they want to be for the company.
Yeah, and I think that the team environment really makes that borrower experience what you're alluding to or mentioning, ironclad, and you need to have that. And there will be bad experiences, but it's, as a company, how do we navigate an upset borrower? It may or may not even be your team's fault, but
Oh, yeah.
it will come up, or their rehab bid just gets blown up mid renovation uh, for
Yeah.
things unforeseen, and then managing that rehab draw schedule. So you guys do a lot of construction
We do a
and,
lot of
and some heavier
construction,
value add.
a lot of
What
rent.
for someone outside looking in, saying, "Hey, I want to start funding construction loans."
Yeah.
What is the we make it through the underwriting. I know the underwriting, it's tough and you need to know what to look
Yeah.
for, but I think managing that borrower experience doesn't get talked about enough during that construction phase. And
So
how
so
does your
here
team handle that?
so I'll take a step back, and this is something that this is what keeps me up at night. So what's interesting about, I'll just say, a pure construction. A guy's buying a house in Encino here in San Fernando Valley. He's knocking down whatever mid-century, ranch was there, and he's building the 5,000 square foot McMansion, and is going to sell it for $8 million or more. So the problem we have with, or I should use the word problem, the challenge you have on construction deals is that, and this is also true for renovation deals as well, anything with a construction holdback, you have two opposing dynamic factors going on. On one hand, you've got the acquisition loan, or in some cases, if it's a refinance, and extreme time pressures to close close, close, close. I want to close now. Quick, 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 quick. So you have staff hustling to get all the paperwork, get the appraisals in, everything checked, underwritten, approved, docs out, and closed. So you have this dynamic of speed, 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 fast, 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 fast. That's on the acquisition, the first part of the loan. The construction part of the loan, we're saying slow down, get your budgets right, make sure you got, if you're asking for bids, make sure your scope is, make sure you have a really good understanding of, the permit process and so forth. Don't don't go too hasty, because if you give me a budget and then after I close the initial loan and that the whole basis of the loan is based on a budget of X, and now you tell me, we screwed up, it's going to be twice that, it completely blow up the deal. So on one hand, close, 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 really, really, really quick. Get it right on the construction side. Slow down, take your time, get your numbers right, so we have budget scope correct, so that we can make sure we're structuring and putting the right loan to you together. So you got to be able to manage those pieces at once. So we have parallel processes. So we have a one track is all the paperwork we need for the borrower and the actual, valuation, and then the second track is feasibility, construction costs. Is it lined up the way we need to have it lined up, so that when we come in for their draws, everything is clean. For example, if there's an ADU in the back, I want the ADU budget separate out, so I know, you're spending X on a 500 square foot ADU in the backyard, and the rest of it's coming to the main house. And just managing that properly. So that's the one, is just the understanding and recognition that you got two opposing dynamic forces that are paradoxical in a way. The second part is being very, very, very transparent and communicative with the borrower. So I've seen it where we have very experienced, but I one time had a borrower call me up, started yelling at me about a draw, whatever, and then I go, hey, the address, and he gives me the address. I go, not even my loan. I go, we didn't do that loan, but we did the one down the street. That's ours, but that one over
I'm
at
just Dr. Phil here. Let her rip. Let's go.
I'd love to help you, but it's not my loan. So even the borrowers, if they're dealing with multiple, and some of the bigger, more prolific guys are dealing with 2 and 3 different private lenders, and we all have our own unique way of doing it, so they get all confused and they don't know. So being able to communicate and being very transparent with the borrower to say, here's what's going to happen. If you do X, Y, or Z and get me this, and this paperwork, and if you give me the budget, please make sure that that budget is accurate. And we even have our borrowers certify before closing. I have them certify the budget, because there might be 10 different versions of the budget. And I just want to make sure I got the latest one, because that's what we're structuring our loan off of. If you don't, it's going to cause headaches. I don't want you to have headaches down the road. So let's make sure your budget's accurate, even if it takes a little bit more time. Just, is this the right one? They start, yeah, that's the right one, Jerry. Okay, great. Now I know you're spending $2 million to build this thing. All right, let's go. But being very, very transparent and very communicative, and even the most experienced borrower, like I said, may not understand your process because they dealt with brand X's or brand Y's, and make sure that they know what your process is, what to expect, what you need. And if you get that stuff, then how it's going to go and when you're going to fund this loan, and then how the draws are going to go. That's the first part. And the second part is that I don't think there's enough emphasis in our industry. This is something that CMA may come in talking about the draw process. I mean, I deal with a lot of calls. My LOs deal with a lot of calls about, hey, I'm building this house and whether I need the loan in 2 weeks and blah, blah, blah. But I very rarely have somebody up front ask me, walk me through your draw process. How quickly can you get me the funds? What do I need? What paperwork? What will you fund and what won't you fund? Will you fund deposits? Will you fund permits? Will you fund architectural fees, soft costs versus hard costs? Not a lot of discussion around that, because people are so micro-focused on get me the loan and I'll worry about it
And
later.
leverage and pricing.
Right.
And
And
they
then when
don't ask.
later, and then when later comes, it's like, that's the wrong time to have that discussion.
Yeah.
So
It's the process-based questions are really the ones that a borrower should press on, or the referring mortgage broker, because
yes,
you get at the leverage and the pricing they may seeking, but they may not understand that these releases are based on reimbursements. We're not pre-releasing, and
yeah.
there's
Or what
mechanics
happens
lien issues and title issues that come into play there, which we won't dive into
exactly?
too much. But
Or what happens if I have a cost override? My plumber was going to charge X and they charge Y's. Can you accommodate? Is there contingency allowance for contingencies? How flexible of a lender are you? How rigid are you? So in some cases, that low rate and high leverage, the shine of that comes off real quick when the guy's struggling to pay subcontractors the next Friday, and there's an argument regarding what kind of reimbursement he's going to get off of a draw because either he didn't understand it or that's not in the policies. That's why we go through excruciating pains to ensure that our borrowers are fully aware of what we do and what we don't, how it's going to work, the timeframes, and have that discussion before we fund the initial loan so that if there's any reason like, hey, does this work for you? If it doesn't, then hey, maybe we're not the right lender for you. If it does, we're going to be the best at it as we can. And here's, arrange your cash flow accordingly. So again, it's that whole managing the expectation of the borrower so that there's no surprises. And that's the number one rule, is to make sure that everyone is well informed.
And I'm sure it's a little bit of frustration from some of your LOs as well that you have that are good at what they do and they're trained, hey, we're going to front load our processes
Yeah,
so they know exactly what's going on. I'm sure you get some borrowers that are more experienced than the rest and they're, well, my other lender right now that I'm shopping saying I won't have to do that. I was like, well, you might want to ask them about their processes and they may
right.
lose a deal or two because of the level of detail up front, but I would not be surprised if that borrower boomerangs back saying, "Hey, Jerry,
Yeah.
and you're not going to say I told you so, but
Yeah,
it's
no.
not."
Or there ain't no free lunch in this business. So
Yeah,
if it's too good to be true, it's usually right. But I will tell you, there's been some really big advancements in the industry in the last couple of years. I know a lot of my competitors have put a lot of time, energy, and effort into upgrading systems, upgrading this part of it, including we just signed on for TrustPoint AI. Put a little plug in for them on the construction management side, state of
nice
the art.
guys. Chatted with those guys a couple years ago. So
Yeah, John Ryan and the guys, they're good guys. And we are so focused on the customer experience that we're pulling the trigger and we're gonna implement, or we are implementing the software out there. But yeah, so again, it's the whole concept in terms of the borrower experience is just no surprises. Make sure it may be hard, it may be boring. The borrower may not even want to hear it, but let me just explain how certain things work so you don't get confused and this is how it's going to work. And you know, it an ounce of prevention, as we say, um, very, very, very important. And by doing that, and again, during our initial period, I used to run all the draws, So one of my top borrowers, a very good builder, he actually works for us now. He came to come work for us, and he was building 2 homes here in the valley, and he comes into my office wanting his first draw, and he drops a shoebox on my desk, literally a shoebox with 50 receipts from, Ganal Lumber and Snyder Diamond Appliances, like literally. And I look at it, and I'm a grown man. I look at my partner Dan, I start crying because I'm like, oh my God, it's gonna take me not. And it took me hours to go through all these receipts and stuff. And I'm like, there's got to
it's
be
like
a
a
better.
1985 tax return with a box of deductions for the year.
Exactly. So hopefully the software is gonna help with that. But just helping borrowers understand what to prep for so that when their draws come through, I don't get a shoebox filled with a gazillion receipts and having to go through them, and tie it to each of the line items.
Yeah, and
So
I think technology has moved extremely quickly the last decade,
yeah.
last 2 years alone, and it's gonna move even faster, and I think there's some very great platforms out there that uh, increase the transparency for your borrowers about the
Yes.
process, improves your accessibility, increases the speed at which you could get a response without jeopardizing the quality
Yes.
of the product, and it's getting that implementation in place and then trusting it, and that's
Yeah.
kind of like the battle at times because there's some really good ones out there, and I think it's going to keep getting better
Yeah.
and better.
If you talk to borrowers, the two biggest complaints you'll hear from borrowers about private lenders, and all lenders, including conventional lenders, um, the two biggest complaints are, particularly for private lenders, is retrade. Hey, I submitted all this stuff. You told me you can do X, Y, or Z, and then at the last minute, you're asking for more equity. You're lowering your leverage or the rates going up. Like, why didn't you know this ahead of time? And that's, like I said, we spent enormous amounts of time avoiding that whole situation by really going through the deal up front. Um, that's number one complaint. The second one is you're asking me for the same piece of paper I've already gave you 3 times. I gave you my Bank of America bank account from last month. Where'd you put it? I know. Like, what are you guys doing with this paperwork? Or why did you wait 2 weeks and now you're asking me for, my whatever, explanation on a credit for something that happened 9 years ago.
Yeah.
So one of the great things with the technology is that with a borrower uploading it into your system, it timestamps it. So if somebody sent me the Bank of America bank statement, I know exactly when I got it. And then my ops team can't lose it because it's in the system and tagged.
Yeah.
And so just things like that, which just increase the efficiency and the effectiveness to address some of those issues. But I'll tell you, I mean, the last time I looked, and don't quote me exactly on this, but on a standard basic one borrower RTL loan, there's 109 individual tasks from beginning to close. And that's not an easy one. If you add additional borrowers and sub entities, it goes up to 120 to 130 separate. So there's a lot of moving parts on these loans, and a lot of coordination. So again, that's where the tech and the AI and all that comes in, is to help kind of organize that and make sure we're focused on the right things quickly and easily, and catch the things that need to be caught in the time frames you need them, so that you avoid any major uh-ohs with the borrower.
Yeah, and it's even with the improvement of technology and automations. One, I think we touched on this earlier, you highlighted. I think you could automate yourself out of existence
Oh yeah.
by trying to over automate to where, hey, now there's no more human interaction on the sell side or even on the processing, closing and post closing. You need to have that human element, but then also there is such a thing as crap in, crap out. And there's still
Yeah.
a manual input on the front end that, ideally you could start rolling it over. But if that initial input is off, you need to still have the checks and balances in
Yeah,
place.
and the cautionary tale that I'm listening to is, how many times have you ever heard somebody on a cell phone, wherever you may be, and you hear agent, agent, because they're on an AI phone, and it's like,
Human. Give me a
talking
human. Human.
agent. I'm sorry, I didn't get that. I didn't quite get that. And it's like, so you can automate yourself out of business because you're missing what the whole concept of being a business about, satisfying a customer. So the cautionary tale is that, yeah, go ahead, deploy AI, go ahead and get the latest and greatest, but they're only tools. They're not the end all. The end all is still a human being saying, does this make sense? Does this right? And communicating with that borrower. Now, there's some borrowers that, they like going into McDonald's and not having to talk to a human, hit the kiosk and the burger shows up, and hopefully that burger's right. We're betting that there's enough complexities to these transactions and enough need for expertise to structure and to discuss and to work with that borrower on what works for them, that we'll always have a highly skilled, highly knowledgeable, highly competent, and a empowered individual at the front lines to be able to work with our borrower to ensure that by the time when they get their financing, it's exactly what we all discussed works for them, and we move on from there. So it's a combination of never losing that human element, because I'm starting to see it. And again, I'm no value judgment on my competitors or anybody else, but you can't just rely on the technology.
No, and you can't just rely on it for valuations as well.
Yeah,
And I think that's where over the some lenders are finding that out on loans they wrote over the last couple of years, just
yeah.
on valuations being off. And yeah, market's correct, and they do that, but there are some pockets you know better than most in Los Angeles. Like you are literally on the other side of the street, main street, and there's going to be a sizable variance in value, and
You
it's
have, and that's a good point, is that all real estate's local. And I think we forget that, particularly, and this is, we talk about expanding. And just from my past experience being, I worked for both Fannie and Freddie, and just having the privilege and the opportunity to just see a lot in terms of just all real estate's local. So you can literally walk a property. You can look at the appraisal photos. It looks great. They're not showing you the across the street with the burnt out meth house, or the graffiti and other things that may impact the valuation of the subject property. You would never have seen it unless you actually walk that property or know that neighborhood in terms of what's going on. um, and so just knowing your real estate is so important.
not absolutely, and it's we see and we're going to see it again, and it's we get to a spot where you could raise too much money too fast, and you need to get it out. And that's also, I think, it's a slippery slope. We've chatted about it over the years.
Yeah, and the unfortunate, and we're not going to mention any names, and I'll say it for the 15th.
It doesn't even need to be about lending. It's just investing in general, whether it's equities, your traditional fixed income
There's
bonds, your
no
hedge.
shortcut in this business, and if you take the shortcuts, it may feel good for the short term, but it's always, and I say always, going to come back to bite you at some point in the future. And so that's, and unfortunately, when certain players that are large enough to do that kind of stuff, they sneeze and the industry will catch a cold. So again, all we can control is us and what we do. We have a very distinct way that we look at, in terms of valuation, in terms of credit quality, in terms of the type of sponsor that we feel comfortable lending to, and no matter what, we're gonna stick to that, regardless of what competition does.
Yeah, and I mean, you get it's very easy to compare yourself to your competitor, and
Yeah,
your competitor may not even actually be a competitor based on the types of loans they're doing,
yeah,
and
right.
it's very easy to feel that everyone around you is just absolutely crushing it, and you're not. And I like to say
Yeah.
there's 3 sides to every story, and there's a lot of smoke and mirrors out there on
Yeah.
what's being.
But but with that, I'll also tell you is that I've had several situations where I know a borrower, like I've done loans for a particular borrower, and I know the guy's a good credit risk for what I do. But unfortunately, he has a specific instance where his information doesn't meet the box. So, for example, I know a guy who's a wonderful builder, and he just went through a divorce, so his FICO score took a hit big time. you know. But I know he's a really good builder. He's rebounding, so if he comes to me for a loan and my standard credit box, he doesn't qualify. But I know if I made a loan, he'll perform. So there is a need and a niche, and again, I just want to be real clear on this for anybody who's watching this: is that there is a need for folks that have their own unique credit boxes, whether it's a family office or a portfolio lender, or a trusted investor, folks who are looking at it outside of the institutional box, that there are many very good, I guess in the old world we call them alt A, that they don't meet the credit criteria as dictated by the institution, Wall Street, or the securitization market. Doesn't mean they're not a good credit risk for an RTL loan. And that's why there's always, the opportunity at home for folks like that with just making sure you're matched up with the right lender who sees beyond some of the credit boxes.
And we follow your traditional trustee investor model
Yeah.
on that. So there's opportunity everywhere. So you need to have a good understanding what your competitors do, because
Yeah.
one, I like to send borrowers to my competitors that I know have a good operation if I can't do
Right.
it, and it allows me to just give that borrower a call in 3 months, ask him how the process has been going.
Right.
It changes the ask. Instead of calling where's the deal at, it changes up the ask. But then
But
more importantly, I know where our competitive advantages are at and our core competencies, and you
exactly.
press on that, and then there's a need, and then with the improvement of technology out there, even for on the origination side, you are able to set up particular searches and filters to be hyper focused and targeted on warmer leads that will kind of fit
Yes.
your parameters
Yeah.
on that. And that's only going to improve on that, but you still have to pick up the phone and
No,
do the work.
absolutely. It's just this work. You still have to, put the time in, get on the phone, talk to borrowers. But I'm really excited about the industry as a whole. I think that over the last, I would say 5 years, that private lending has kind of come out of the shadows and is starting to be, it not starting, it is recognized as a legitimate, unique, lending space. There had been some negative connotations about our space in the past, so I think that's also, CMA plays a role in this. Some of the other, national organizations play a role in promoting the industry as a, because people try to still call us a hard money lender, and I kind of say no, we're not a hard money lender. There's nothing wrong with hard money lending. That's based on strict equity, and no matter what, that's all that really matters. Where I say we're an institutional private lender because we have guidelines that we underwrite both the real estate and the individual. But I think we still have a ways to go as an industry to promote that we're up and coming, and there's a lot of very legitimate, good lenders in the space that you can trust.
Yeah. You mentioned you're in 22 states now. I know
Yeah.
you started in California. What was the first state you guys ventured into outside of California?
Washington.
Washington,
Actually,
and
Hawaii. It's funny. We got a request for a Hawaii deal. So the first thing I do is I call. Well, they were Jurassic, now they're Fortra.
yeah.
I go, do I need to be licensed in Hawaii? And they said, knock yourself out. Uh, you know, and so and then the next call I made was to my construction management team and said, do I got a guy in Hawaii that can manage, the draws and that can walk the property? Yes, we got a guy in Hawaii. So, but it was basically Washington up in the Seattle area. And I happen to know that area because I'd done some business in the past there. Hawaii was fairly new, and I knew who, again, just from my past experience, I've lent or bought loans in every state in the country, including Louisiana. That's a whole nother. Louisiana's got the weirdest laws. Sorry for anybody from Louisiana watching this. I love your Mardi Gras lot. Wonderful town. But Louisiana does have, different real estate laws. I'll just leave it at that. But it was Washington, and then it was Hawaii. Um, the thing about California, California's got the strictest licensing rules by by far than any other state in the country. So obviously we're here in LA and in California, and so we first started with Cal DRE, then we went to get our CFL. I got 2 or 3 CFLs now. But then we wanted to go to Arizona. Arizona requires licensing, and Oregon requires licensing, and then Nevada. So all the adjacent states require, licensing, which we now have our Arizona license, our Oregon license, and I don't want to let it Nevada.
Yeah.
Long story. If anybody's out there that you want referrals, let me know. But Florida was the next one because I lived in Florida for 10 years and know particularly South Florida. So again, we went into markets that we knew already. And so I knew the Florida market really well. We knew Washington really well.
Yeah, and I feel so 20 years ago, extremely difficult to expand out of the state of California in your traditional private lending type model.
Yes,
It was just because one, loan documents. You would
I
have
was
to
just going
find
to
an
say that.
attorney in that state that could do your loan docs. With technology, that has been eliminated. You still got to be able to verify it, but the ability to draw docs across state lines has become a whole lot more economical
Oh,
and streamlined.
absolutely. And a big tip of the hat to, Lightning Docs and also Dennis Doss, the two main factors that we're able to provide at a reasonable cost. Hey guys, don't raise our price. Thanks. At a reasonable cost to be able to do multi-state. And they've already checked it out and everything. So you can be confident that you don't need to go spend $10,000 on a local attorney to handcraft your docs. I think that was huge to your point, Brad.
Yeah, and then also the ability, since it's cloud-based, to update that. Like we talked on earlier, the biggest risk I see in any transaction, it's not the borrower, it's a legislative risk that sometimes stuff just gets retroactively applied. You can't fight that.
Right. Right.
But if there's an update from the state level that needs to be implemented in the docs, they could update them as
Yep.
real time as possible. Where in the past, it's like I had to email the attorney, any updates going into next year that we need to keep an eye on for our docs or any adjustments. And imagine doing that across 25 different states,
It, it,
30
it,
different.
yeah, and just to sort it all out and keep it all, to keep it all right is
Yeah,
a lot of work. So yeah, so having the ability to have kind of these standardized docs across, and oh, by the way, that the cap markets will accept. So
yeah.
you tell them using Lightning Doc, they're like, okay, enough said, you're fine, kind of thing.
And the second biggest hurdle was loan servicing. A lot of lenders in California, whether they'd self-service their loans or use a loan servicer, the technology and platforms weren't as robust as they are now to give you the confidence to really cross state lines. And there's a lot of risk in loan servicing. You got to each to
Yeah.
your point on Louisiana versus New York versus Florida versus Arizona, they all might have their own little minor tweaks on
The
what you can and cannot do.
the third one I'll add on to it is valuation. So having the ability to have the ABMs, and also some of the national providers, they've been there for a while, servicing the conventional world, but being able to run a CDA, off of a website where you can get, and even just, hate to say it, but Zillow and Redfin, you can get really good data off of properties anywhere in the country. And you can run an in-house kind of valuation and see if I'm close to the numbers. So just the availability of data and services, that can run, valuation pieces, also contributed to our ability to comfortably. And then also just getting the metrics back and looking at MSA level data, zip code level data of performance on, where cap rates are going on multifamily and where, values are going for particular pockets of homes and stuff. So all that kind of contributes to the ability to go national or go across state lines. But again, all that data is good, but and this is part of what we've understood is that you still got to get out there and you got to know your markets, and that's the part that you just got to, I've seen this movie before back in the old conventional world where these lenders get into markets that they don't understand. Like not the entire world trades like LA, and just because LA does what LA does doesn't mean that Cleveland is going to be, act that way, or
Well,
Seattle or Des Moines or Miami.
something as simple as the foreclosure process
Yeah.
in that state is it.
Oh,
Yeah,
yeah.
and that your protective equity you thought you had is now gone in legal fees to hope to get your principal back or see it through, and it's, it if we go down this rabbit hole, Jerry, I'm not gonna let us go down for 'cause we'll start
Yeah.
drinking too early for today. I told you this hour go fast, but I still have a couple
Yeah.
questions
Oh my
for you.
God. It's already, yeah. Okay.
A couple
Well,
questions for you. For Spreo
sure.
Capital, where do you guys see the opportunity over the next 12 months, for loan originations for your company?
You want to see what the types of loans, the amount of
No,
loans?
where when you're talking to your sales guy, your and gals, where are you telling them, "Hey, I'm bullish on the market the next 12 months when what we're doing." Where do you see the biggest opportunity for your team, as in whether it's in commercial or construction or DSCR? What are you
Oh
guys
yeah.
seeing?
So twofold. One is again, we're focused on certain MSAs that we think are conducive to the RTL product. So, existing old housing stock that hasn't been updated in quite some time, and jobs. So, markets that have, job growth or projected job growth. And you don't need to be a scientist or a genius to like take those criteria and say, okay, this town, this town, this town, this town, not so much.
Yeah.
But just picking your spots of where you think is where our product is going to do well, and there's a need for it. The second one, DSCR is I just had a long conversation with someone yesterday on DSCR, and it's an amazing space. And what's happening is that DSCR has been out for a little bit, and the RTL world's been kind of slow to adopt it because you either were an RTL lender or a DSCR lender, and when we try to do the switch over, people kind of stumble. Just I'm talking generically. I'm not pointing out any particular lender. So um, I'm seeing, and we are seeing that your conventional Fannie Freddie lenders have now discovered DSCR and are rolling it out. I had a meeting with a broker just the other day who is sending some of his loans to one of these residential guys. And he goes, Jerry, I'd much rather send them to you because you understand this space. They do not. So even though they're just a middle guy going through to whoever, there's a handful of large players that are buying up all the DSCR. So I think there is a tremendous opportunity in the market for anybody in our existing space, like private lending, who understands the concept of commercial real estate in our world, that is knowledgeable and can be out there and be a source of information and can run circles around some of these guys that they can't even spell DSCR. And although their company offers it, you ask them a question and they'll have to go run back to an underwriter and find out. So to me, I think there's a tremendous opportunity for those LOs who want to specialize in being the DSCR experts, knowing everything there is to know, how the different investors, there are slight the vast majority of the product is similar. There are slight differences on the edges on some of one will do a multifamily up to 10 units, one won't, one will allow DSCR to this, to that, and being an expert in the product that your company offers and being able to really source a lot of really good business because you will be sought after because of your knowledge and being able to advise that borrower on what's the best DSCR product to get for their specific need.
Yeah, and it's very much it goes back to processes because it's a lot of the same money buying this product behind the
Oh,
scenes.
yeah, yeah.
It's very big pool, small buyer. You know what I mean? But it's the capital providers out there. It's some have really good processes. Some might be a little bit more clunky. Then you have others on the conventional side that are almost bringing their non-QM branch to process this
Mhm.
through. And heck, depending on who you as an originating broker are, it's very much a brokered product. That originating TPO or broker that is guiding their client through it. It's if you could deliver with a high level of confidence that the loan's going to be there within 10 days based on your initial needs list and your confidence in the money behind you, that
Yes.
other company might not even be having that initial needs list going out within 10 days. So it's how are you, to
Right,
your
right.
point, being an expert in the processes to make sure they could guide it through.
Speed and ease, but also what's interesting, and this is kind of also kind of a phenomenon that's in the industry. It's very similar to Fannie Freddie. So you go to any lender in town who offers Fannie Freddie product, the product's exactly the same. There are some differences in their negotiated contracts with the agencies, but the rules are the rules, the ratios are the ratios. However, there are many ways to adhere to or to satisfy a particular rule. So the guy who knows the rules but knows the intent behind the rule, what they're solving for, and knows all the alternate methods to solve for that rule, it has a leg up. So even though two guys are competing with exactly the same rules, the guy who knows that there's three different ways to satisfy that rule and able to provide those to the borrower and figure out the most convenient, easiest way for that borrower to satisfy that rule, get the loan. The other guy says, no, it's got to be this way, and I need a paper that looks like that, and that's the only way to do it. He's at a disadvantage. So again, being knowledgeable, but not just knowledgeable on the rules, but how to comply and satisfy those rules in your own unique way that will be satisfactory to the investor.
That's a very good point. And we're going to be actually having a DSCR panel in March where we're going to be doing a different style. We're going to break in on how the loan product works. But then I also have Dylan Freeman with Fidelity. He does a lot of DSCR loans, and I'm going to be pressing him on origination strategies, navigating objections. To
Yeah,
your point, having a deep understanding of the rules. So it should be a good time.
but there's a huge amount of opportunity there, particularly as the market is embracing the product. So
Yeah. And then one more question for you. Who is Jerry? What does he do for fun when he is not in the office or working?
Oh, so my girlfriend, I'm a foodie, so we look for cool food places, hopefully with live, so foodie, live music, and watch a lot of Netflix. So in my spare time at 2 and 4 in the morning, but just honestly, just socializing, just hanging out with friends, having dinner, and being able to kind of turn off a little bit until the phone rings and I got a bar I got to take care of.
Well, Jerry, this 1 hour went by in a blink of an eye. Again, I can't thank you enough for your participation and support of the California Mortgage Association. I really appreciate that, and I also value the friendship we've been able to establish over the years.
Fantastic.
And I'm looking forward to chopping this video up and reviewing it and
You're
checking it
pretty
out.
good at this, man. You ever think about a talk show?
Shit. No, no, and it's funny. I'll leave it with this. Like I cannot call this thing a podcast, but it is, and I've just been so
You're
negative
pretty
on
good.
the
You're a
podcast
good
scene over
interviewer.
the years. And it's like, nah, it's just an
Yeah,
interview. We're just talking shop on camera. Uh,
absolutely.
but
All
again,
right,
Jerry,
Fred. Well,
thank you
thank
again.
you.
And
Back at you. Again, my hats off to you. Thank you for so much that you do, and also to the staff of the CMA for just keeping everything rolling. They also don't get enough credit, so my tip of the hat to them as well. Thank you.
I appreciate it.